Kitco Mining's special coverage of the Bank of Montreal's 32nd Global Metals, Mining and Critical Minerals Conference is brought to you by First Majestic Silver.
Hello, this is Paul Harris for Kitco at the 32nd BMO Global Metal Mining and Critical Minerals Conference in Hollywood in Florida. This afternoon, I have great pleasure to be joined by Ammar Al-Joundi, President and CEO of Agnico Eagle Mines. Good afternoon.
Good afternoon, Paul. It's great to be here.
It's great to have you. Thank you very much. Agnico Eagle had a pretty solid 2022. Congratulations there. What were you most pleased with your performance last year?
Well, first and foremost, it's always safety. We had the safest year in a 65-year history of the company. Nothing's more important than the safety of our employees, and good safety is also an indicator of well-run mines. So very proud on the safety side, but also very proud we delivered solidly into our guidance, solidly into our production guidance, and towards the upper end as we had guided on cost, which is quite something given we had a year with the highest inflation in the last 40 years.
I listened to your conference call and you talked quite a bit about cost inflation and how some of that is still in your outlook. How do you see costs evolving over the course of 2023? Has cost inflation peaked, or are there still areas of concern?
Well, we don't like to say cost inflation has peaked because we don't know if it has or not. Inflation is, of course, still a concern, but I'll say a couple of things. First on inflation and then the broader question on costs. On inflation, some of our peers, I think, have assumed input costs are going down when they've given their cost guidance. We haven't. We took the numbers that we had at the time we did our budget, November and December. Those were the input costs we gave in our budget. We have seen relief. We've seen relief since then on energy. We've seen relief on some inputs. And importantly, Paul, we've seen big relief on the currency. That's one of our biggest exposures. So that's the question on inflation, which is, it's still there. It's too early to say if it's peak or not. We're seeing relief. But the other big point on costs, which I think are important, is you have to be careful that people like myself don't blame everything on inflation. Costs go up, well, it's inflation, it's not my fault. The truth of the matter is, inflation is there, but sometimes mine plans change. And for us, we're guiding lower costs going forward, not because we're assuming less inflation, but because we know our mines are going to be producing more gold, which is going to reduce costs.
Okay, thank you. Now, during your conference call, there was several things that really sort of piqued my curiosity or really struck out to me. One is that the company's strategy to dominate certain districts successfully is really playing out quite well. And you mentioned that Malartic in the Abitibi Gold Belt in Quebec and Kirkland Lake in Ontario, they both are showing the potential to be 1 million ounce a year producers each. And you mentioned that that's perhaps comparable to Nevada gold mines in Nevada. What was the strategy there to get those assets up to that level of performance?
Well, it's always been our strategy, as you say, to consolidate what we think are the best regions in the world based on two criteria. One is, does the region have the geologic potential for multiple mines over multiple decades? Because that's how we think you get to be really good miners. And two, does it have the political stability to actually be able to operate multiple mines for multiple decades? And in the world, based on those two criteria, arguably the best place in the entire world is the Abitibi. And that's a region where we've largely consolidated. We have as much gold in the ground and produce as much gold as Barrick does, their portion of the Nevada JV, which is a fantastic asset. So it's a great region. We have great assets. But what really excites me is the benefits we can get by consolidating. As you say, we're looking at Detour. We're looking at the potential to increase that mine from 700,000 ounces a year to over 1 million ounces a year. And this is a multi-decade mine that already has a mine life past 2050. We said we were going to give more guidance on that at the end of this year. We're working on it. But that would be fantastic. Million ounces a year, multi-decade, safe jurisdiction, good ESG, clean energy, good relationships, etc. We also have the potential at the Malartic mine, the other half of which we're going to be getting soon from the Yamana deal. We think that mine has tremendous potential. I'll just give you some high-level numbers. We think it can go as an underground. It's right now an open pit mine. It'll transition to underground. When it transitions to underground, it'll be about 600,000 ounces a year, but it'll have 40,000 ounces of spare milling capacity. We think that we can add somewhere possibly north of 500,000 ounces a year incremental to that, and putting that as another mine producing more than 1 million ounces a year for decades in a great jurisdiction.
Well, thank you. Now, M&A is very much a topic of discussion. It always is in the gold space. Agnico Eagle has been very successful, done some very, very good value accretive deals recently. And as you mentioned, the Yamana deal is about to close. In that deal, you're getting the 50% of Canadian Malartic you didn't currently own, and Pan American Silver is getting the rest of the Yamana assets. How did that deal come about?
Well, just for clarity, we're getting all of their Canadian assets, and Pan American's getting the rest. So there's some other Canadian assets, including Wasamac.
Wasamac, yeah.
So that deal, it's a very good question. We've always wanted the other half of the Malartic mine. It just never really was available. When Goldfields and Yamana announced their deal, then Yamana's in play and everything's up for grabs. And the market reaction wasn't great to the original deal. And very simply, as our CEO, our executive chair, I should say, he used to be CEO, Sean Boyd says, it's really about putting the best assets in the right hands. And the Canadian Malartic mine is a great mine that we shared quite happily with Yamana, but there's nobody else in the world who had the ability to fully utilize that mine. We can, we've been there for 60 years, a lot of our people were already there, and we have a lot of assets around it that can use the spare milling capacity. So it was a situation where it became available because of the Goldfields bid, but I think it was clear to everyone, including the shareholders who voted on it, that nobody in the world was better able to optimize that asset than Agnico Eagle.
Okay, thank you. Now, a very transformative transaction for Agnico Eagle. Congratulations there. Some other deals have been announced recently amongst some of the big companies. Now you've done your big transformational deal. Are you sort of sitting back on the sofa, getting the popcorn out and enjoying the show?
We are a little bit. No, look, we think consolidation in the industry is good as long as the best assets end up in the right hands. Smart consolidation is good for the industry, and what's good for the industry is good for us as a major player. So we're very supportive of smart deals as they happen, and sometimes they present opportunities beyond just the deal itself. So yes, there are deals going on. We think actually 2023 you're going to see a lot more consolidation, and that could be a good thing in this industry.
Okay, thank you. And I have to ask, have you finished with your consolidation drive in the Abitibi? Because there's a handful of other juniors with 1, 2, 3 million ounces there that would potentially fit in very nicely into your plan to utilize the spare milling capacity. Yep. You mentioned today and in your conference call about 500,000 ounces potentially of additional production. There's perhaps some other companies you could buy, some juniors you could buy that could really help shovel some more ore into that concept.
Well, that's a great question. Right now, we're focused on delivering what we've already identified, which is the potential for another 300,000 ounces a year, the potential at Detour, the potential for another 200,000 to 300,000 from the ore body itself at Malartic, and then an additional 500,000 through using mill capacity. So the total number really of the optimization is closer to 1 million. And importantly, and this is key, a lot of that is without having to build a new mill, without having to build new tailings facilities, which are typically half the capex. So in a place where we already have a 2 million ounce a year of production, the Abitibi, if you can increase that by 1 million ounces at half the capital cost and double the return on capital with half the environmental footprint, this is really where you get the benefit of a consolidation. This is something that's going to take several years for us to do, but it's massive. And to your point, of course, it makes sense in the interim to see what's around, to see what's available, because yes, if there's a junior with a mine that's close by, almost certainly it makes more sense to have that gold processed at an existing facility rather than having to build a new one.
Given the complexity and difficulty of permitting new mills and plants,
absolutely,
having those bits of infrastructure, such an incredible advantage.
Absolutely, Paul. It's not just the return on capital, it's the risk adjusted. I mean, you have to get, it makes the permitting easier, it's a smaller environmental footprint, it's less risky, and again, it's in a really good part of the world where we have a competitive advantage.
Okay, thank you. Now, it seems Agnico Eagle is very well poised for what's to come in the gold cycle. Gold this year has been on recently a 4-week losing streak, but it's still at quite a healthy level at $1,800 per ounce or just above that. Why do you think there's so little love for gold at the moment?
Well, it's hard to predict gold price in the near term, but I think the long-term fundamentals are very strong. I got in this business in 1999 and gold was $260. Now it's over $1,800. So the trend has been moving, but it's been volatile. Look, gold is one of these things a lot of people trade, but the underlying story, which is it is a real currency. It's the only real hard currency left in the world. And given what's happening in the world between governments spending like crazy and, frankly, some of the political instability, in the long run, gold has to and will continue to go up. But I think it's problematic to predict sort of 3-6 months intervals because it has been very volatile.
Okay. Now, we're at an investment conference. Agnico Eagle pays one of the best dividends or has one of the best yields in the sector. Are you starting to see generalist investors or new investors come to you?
We are, but what the generalist investor really wants is a profitable company run well. And there's a lot of hardworking people in the gold space, but we don't really have a great record of return on capital. And that's one of the reasons, as an ex-financial guy, well, still a financial guy, I'm really excited about what we talked about, leveraging existing infrastructure and double the return on capital. You will never get in this business a better return on capital or risk-adjusted return on capital than leveraging existing infrastructure. So to get the generalists in, you've got to make money, you've got to make return on capital, and that's what we're working on.
Excellent. Well, it sounds like there's a lot more to come from Agnico Eagle Mines. Ammar Al-Joundi, thank you very much for joining us this afternoon.
It's my pleasure, Paul. Thank you.
I'm Paul Harris. Stay tuned to Kitco for more from the BMO Metal and Mining Conference.
Kitco Mining's special coverage of the 32nd Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver,